maybe I can't be the only one that's been throwing money into the dumpster fire that's been the market this week, which is honestly the worst week we've seen since the beginning of the year. And over the week, so many of you beautiful buggers have been leaving comments, questions down below. And in this video, I said, hey, I should respect you and answer those questions that you guys have. We're going to be talking about my dividend ETFs, my long-term ETFs, what I'm buying today, what I'm buying tomorrow, Canadian, US dividend stocks, would I buy Tesla, what would make me buy Tesla. I mean, you guys asked a lot of intriguing stuff, and if that's a conversation you'd appreciate, damn it, hit that like button. Let's get right into this with question numero uno here, being what's the point of diversifying if you can just increase your stake of VDY monthly? In 10 years, you'll get like 25 to 35% dividend return in that investment. This is the Vanguard Canadian High Dividend Yield ETF, and currently the only exposure I have to the Canadian markets. I've invested over $150,000. I bought another few $1,000s worth just last week because it's been dipping pretty heavy here. And honestly, I wouldn't put all my money in this ETF. I am nor a dividend or growth-oriented investor. I try and parity both of those because obviously long rates of return haven't purely been from dividend stocks. And just taking a look at the concentration, this one's way too concentrated to solely be investing in this ETF. I mean, Royal Bank and Toronto Dominion Bank make up over 25% of just this entire ETF. You got Enbridge, you got Bank of Montreal, Canadian Natural Resources, Bank of Nova Scotia. I love this ETF, but I recognize the lack of security and the risk you're putting yourself at buying this because you're over 20% exposed to energy, over 50% exposed to financials, and sure enough, then crap, when things start to fall apart like they are now, this ETF is going to take the brunt of that, which is why I'm trying to parity this ETF with the Vanguard FTSE Canadian Index. And I haven't bought this yet, but I'm going to, and I like getting the broad exposure to just the Canadian markets because with this one you can see you're also getting Royal Bank and Toronto Dominion Bank, not nearly as concentrated, but as we head down you're also getting Canadian Pacific Railway, Canadian National Railway, you're getting things like Shopify and Brookfield Corp, things that don't show up in the high dividend yield ETF that I think are prudently important to own because they've been very stable and they offer really good and they're very good investments to have exposure to. But the best thing with the ETFs, it takes the management out of my hands, so this is all market cap managed. I'm not as concerned about it, and I want to parity, that's probably not the right word, but I want to pair my entire portfolio around 4 pivotal ETFs. I obviously want VDY. I'm going to put 200,000 in this ETF. I probably want to get another 200,000 in VCE, which by the way pays 3%, which is really nice. I want to put another 200,000 in the S&P 500's VOO, and then another 200,000 in the Schwab US Dividend Equity ETF. So these 4 ETFs will be the primary pillars, and they'll make up 800,000 in value. I'll get really incredible yields, but I'll also get broader exposure because at my age, in my youth fading away from my eyes, I'm really looking for long-term stability and reliability, which you get from these kind of ETFs in this diversification side, because I'm still buying individual stocks. I just don't want it to be as big, and I'd like to have maybe 50 or 100 grand in cash, and this is long-term thinking out. I'm a ways from getting to that point, but you know, we got to have those long-term dreams. So I'm trying to build the pillars now and continue to build on them over time. Leading us into the next question here, when are you getting back into Tesla, Kyle? Now, every time I talk about this, people get pissed. I love Tesla, the business. It's probably going to be one of the largest companies on the planet in the future. It'll be up there with Apple and Microsoft in its market cap. It's going to dominate the entire auto industry. I mean, it's pretty apparent at this point for anybody that's been paying attention. The thing that I don't like is the stock. And I kept telling you guys, if the stock dropped below $100, I'd buy it. We almost got there, and then it rallied back. The problem is this company right now doesn't commercialize anything with robotics or software, AI, anything they're doing from that end of it, and they're not making any money off self-driving. The only thing they're making money off of is cars, and they're having to lower the cost of those vehicles to keep the demand up in this recessionary environment, and that's shrinking their margins. This is purely just an auto business, and I don't know how to value that over the next 10 years because I still think at $180, $200 a share, your rate of return purely from the auto business is going to be fairly lackluster from what we saw from 2019 all the way to 2021, which is why I took profits. Now, if there's one thing I'm good at, it's recognizing that when you're buying growth stocks, that inevitably you're going to have to take profit. And I watched a lot of stupid diamond handers convince you to hold shares up at these crazy high valuations. The fact is if you are not willing to buy the stock when it was, you know, this is all post-split numbers at $407 a share, and you're holding the stock and you're not willing to sell it at $407, you're an idiot. Because if you're not willing to buy it at that price, but you're not willing to sell it either, and you're waiting for it to drop so you can buy more of it, doesn't make a whole lot of sense, because you don't know when this premium value will ever return. Now, we don't know what the tops or the bottoms are going to be, but obviously I've done a pretty good job at predicting some of this and taking profits along the way, because I've outperformed every YouTuber I watch, from Jeremy, Everything Money. My performance is pretty insane because I've learned to take profits and continue diversifying. So with growth stocks, you got to find the right price to get in. You also got to take profit when it gets too hot. You can hold it for long term and see where you end up, but that comes with exposed risk. So this is why it's funner to invest in ETFs when you get a lot of money and you get old. Because when you're young and you're 20 years old, who gives a shit? You could buy this and forget about it for the next 30 or 40 years. When you get in your 30s and 40s, well, you might only have 10 or 20 years, especially if you want to retire early, to get a rate of return out of this. And that's a very short time frame for the high valuation you're paying for it. So you got to understand where I'm coming from and the projections that I have, because I want to be retired sometime between 35 and 40. So I don't know what the next 5 years looks for like for Tesla, but I think it's overvalued at $180 to $200 a share. It's just my personal opinion. Whereas stocks that I think most people should pay attention to that they don't, I don't never hear anyone talk about these stocks, but things like Procter & Gamble, I'm hoping the market takes this down with it because it's an expensive company. But I like these boring companies because you know what? Not everyone's going to buy a brand new Tesla. I'm not going to go buy a brand new one. Are you nuts? But you know what? I'm going to need to buy toilet paper. You know, I'm going to need to buy some toothpaste, you know, all that fun stuff that Procter & Gamble sells. So if this thing dips heavily, these are the kind of individual stocks I'd be more intrigued to buy than Tesla at my age, right? Looking for longevity, because Procter & Gamble never gets too overvalued. It never gets too undervalued. It always just trades in this healthy premium because people know what a secure kind of investment this vehicle is. Same thing with things like Pepsi, Costco, Visa, these incredibly boring companies that hardly ever dip. But when they do, I think these are more advantageous for someone like me to buy at this stage than something like Tesla. But again, if Tesla comes into a favorable value, of course, I'd be intrigued to buy it as an individual investment. But anyways, moving on, still in 50% cash. This is a bear market, and be careful. The opportunities will come, but much lower. Seen this many times before. So here's the thing, right? We're already in a period of opportunity. I'm seeing it in bank stocks. I've been buying things like TSM. I see value out there, and I'm not going to sit on my hands and wait to see if that value gets better, because I recognize it for what it is today, and I don't know how low the market's going to go. But when it comes to cash, I don't think there's anything wrong with having some cash on the side. If 50% is your comfort level, then by all means make it 50%. I know Dave Ramsey and a lot of people out there are like, oh, no more than 6 to 12 months of an emergency fund, because then you're just bleeding money because you're not getting a rate of return. You're losing it to inflation. But that's not exactly true, I think. I think to sleep easy at night, different people have to have different levels of cash. For me, I leave about 6 to 12 months emergency fund. My fiance, she likes having more cash. It makes her comfortable. And a lot of people operate at different levels. So if you're worried about the market tanking and 50% cash makes you sleep easy at night, by all means. But obviously I would still be cost averaging into the market. So I mean, you know, even if you're not looking at buying aggressively, hopefully you have indexes and you're just going to continue to buy, because you should always be buying, because we don't know when the bottoms hit. Now, Canada only has a few types of stocks worth investing in. Banks are one of them. Let's go. Yes, Canadian banks, by far world renowned, some of the most secure investments on the planet. They've survived every crash better than the US has, and they continue to pay dividends through all those crashes. So I love the Canadian banks, but there's a lot of good stocks out there. We have a few growth companies like Shopify, like Constellation Software. Most people don't recognize Canada as much of a software play as much as we are like a commodities play. So we got our oil giants, you got your banks, your telecoms. There's a bit of diversity in there, but honestly, you can just get that all through things like VCE and again, VDY. Again, we're talking about railways, really secure investments. But continuing on, what about Canadian medical REITs? So I've been talking about things like MPW. This is going to potentially be a short squeeze opportunity of a lifetime. Not that I'm buying it, but it's intriguing because it's over 25% of the entire outstanding shares are short, and this is a medical hospital property REIT. I mean, you're going to be using these hospitals, and this thing has fallen off a cliff because there's been a lot of bad rhetoric, and this is a US play. So I mean, unfortunately, they've seen bad management with parts of their property, and there's been issues. They've been dealing with it, and the dividend yield's 15%. Honestly, the last time the stock got this low was in 2008, and it did recover. I'm expecting there to be some recovery because the shorts will inevitably get squeezed out. At what price? Who knows? What we need to see how that works out. So I don't really talk about it as much, but there's something called Northwest Healthcare Properties REIT, which is the Canadian counterpart to MPW. And this one also been falling off a cliff. Why? I'm not 100% sure. I try and avoid REITs right now as much as I am just analyzing them. I still like RioCan. There's a lot of Canadian REITs that I'd be fine buying on these dips. But when it comes to things I don't understand, I have to see what the earnings do, and there's going to be earnings coming out for this one March 30th. So that's what I'm going to be paying attention to with this one, just to see how they're handling the interest rates environment, how much capital are they using. Everybody's writing down property values right now. Everyone's fighting with payments to the banks. So it's hard to trust this 9% yield. It's hard to trust a 15% dividend yield. But if you got a bit of money, you like to gamble, I don't think you're going to go terribly wrong with stocks like this, but you definitely want to be cautious and play it by ear. But these are a few comments, questions that you guys asked below. Consider leaving one down there. Maybe I'll answer it in my next video. But stay cool, stay awesome, and as always, I'll catch you in the next one.